we look at world markets, we see the same sorts of behaviours. See, when you wake up in the morning and you turn on CNBC, the first thing you're looking for is what happened with the Dow and the S&P. Sorry, you're looking in the wrong direction, but anyway, that's what happens. When the markets in Asia open, they look to see what's happened in the Dow, they look to see what's happened in Australia and Japan, because we open at the same time, except when there's daylight saving. It's an interesting little...
That happens this Sunday.
That's right, it's a little technique we can use there. But anyway, so we look at what's happening in Australia and Japan. When India opens, it looks at what happened in the Dow, in Australia, in Europe, in China. Sorry, not Europe, in Australia and Asia. When Europe opens, it looks what's happened in the Dow, blah, 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 through India, etc. But the influence of the Dow is progressively reduced as we look back. For us, the most recent market is closed as the Dow, so that's where we look.
Yeah, yeah.
For Asia, the most recent market that is opened is Australia, plus the Dow. So we do that all the time. Every market is self-referential. Go back and read George Soros, The Alchemy of Finance.
Yeah.
It's a reflexive system.
Something that I find interesting as well. You talked about Korea and the way their market moves. Where do you see Japan falling into it? Is that
falling is a key word.
Is it a real leading indicator?
No, not at all.
No.
And this is again another factor. Korea has only become important in the last 12 or 18 months. Not before that. Before that, that relationship didn't exist. Now, we move to daylight saving in Australia shortly. Look at what's happening in Australia. Look at what's happening in the Nikkei. And what you'll tend to find, what's happened in the past, is that you can look at the Australia Open and its behaviour, and that is duplicated in the Nikkei. So you can develop a strategy for the Australia Open on index trading and apply that to Nikkei an hour later. And trade it successfully. We currently do that between Australia and Hong Kong. We look at what happens in Australia, and we find that that's pretty much duplicated in the openings in Hong Kong, unless there's been a major event in China. So we can test a strategy in Australia in the first hour of opening, and apply that strategy in Hong Kong in the first hour of opening. Global markets are interrelated.
Yeah.
We're a long way from the rest of the world, and too often we're disconnected from the rest of the world. But in fact, the rest of the world gives us all sorts of trading strategies that we can apply here.
Yeah.
Just as you have leading and lagging indicators, leading and lagging stocks, some stocks develop patterns more quickly than others, then you have leading and lagging markets. So what you see here happens here and happens there. So if you can test it here in theory, you can apply it in reality there.
Excellent.
And new instruments like CFDs give us that advantage. Before it was exceptionally difficult. It was very difficult to trade foreign indexes. You had to do it with your futures or have separate accounts all over the place. Now, you can log on to IG markets, to CMC, to City Index, whatever. You can trade all those indexes from one desk.
Yeah, it makes it incredibly easy.
The world's there.
Yeah.
And once you've got a world of opportunity, life's much easier.
I think some people find that hard as well, though, because they don't know where to start. It's like...
you just have one technique.
Yeah. Which you started with, that's what you said.
Look at the average bank robber. Okay?
Tell me about the average bank robber.
How many techniques does he have?
One, I imagine.
And that's all he needs.
Yeah.
He doesn't, he robs ATMs.
Yeah.
Doesn't go and rob the bank next door, that's too difficult. He's just concentrating on ATMs. What are they sitting there, blowing them up or something?
Yeah.
Or putting little cameras in them. There's all
credit card skimmers at the moment, all that stuff. He's got the one method.
The average thief has one method. We're a thief in the market.
Yeah.
What we're doing is we're trying to take money from the market, preferably without hurting anybody.
And to use it for good, like Robin Hood.
Oh yeah, that's right. Yeah, for our own good. But that's what we're doing. We're trying to take money from the market. So you don't need a multiple set of techniques. How many can openers do you need? You just need one.
Yeah.
So what you're doing is you're using that technique to find the opportunity that matches.
Yeah.
Okay. A stupid thief will hold up a taxi trying to get hold of money. He doesn't know where the money's located. So you've got the technique right. Stop, give me your money. But he's in the wrong place.
Yeah.
So it's the same in the market. We have to first of all develop the technique, the approach that we are most comfortable with.
Yeah.
And we talked about breakout trading. Let's just concentrate on that. So breakout trading. Okay. So what I need to do is find a breakout. So I've got a whole range of technical scans that will help me to identify where that is. The Google map bank is here.
Yeah.
But I can apply it to the Australian market, I can apply it to a foreign market, I can apply it to an index, because a breakout is a breakout.
Yeah.
It doesn't matter whether it's on an index, whether it's on a commodity, whether it's on a stock, whether it's a gold mine or it's a bank, all the same. That's the way they behave.
Very good. I haven't actually heard that analogy there, and it does provide some good insight. I suppose just coming to the tail end of the interview, I have got a few subscribers who sent in some questions, so I might fire those past you if I could. Robin Mosby actually wanted to know if you're familiar with Dr. Bill Williams' moving average and the MACD, and how does that compare to the GMMA?
Okay, the key differences. I mean, Bill's on about chaos, and he's done a lot of valuable work in that area, but we need to take another step, and which is what the GMMA does. The GMMA looks like it's simple calculations, and it is. It's only 12 exponential moving averages. But what it picks up is volatility clustering in the market. Points of volatility where they come together because a market is an inherently unstable system. So this is an extension of chaos theory. And chaos theory, part of what we're looking at is fractal frontiers. We're looking at volatility clustering and the way it creates instability, the degree or level of volatility, heterogeneity in the market. What we do is, with the GMMA, is put that into a trading solution. And that, I think, takes a step or two beyond what Bill Williams is doing. Bill is saying, look, here's what's happening, and his understanding of chaos and so on is excellent, there's no question about it. But he's using older methods to measure new phenomena. That's perhaps the best way of putting it. The methods that he's using to measure are not new measures for new phenomena, and I think that's where GMMA sits in, because the market is a fractal, and there's another set of theory out here that talks about fractal behaviour in the market. Again, theoretically, it's very, very good, but in trading terms, it doesn't give us the solutions we want. And if I can sidetrack for a minute, ATR, average true range, is a perfect example. You go to Metastop, and you can do a wonderful display of ATR, and it does this. And it's perfect. It's a correct theoretical or correct calculation of average true range. And that's absolutely useless for trading. Because if I put ATR on a price chart, it goes up and it goes down. And all you say is to stop. First rule on a stop, never lower your stops. Yeah. A rising trend. ATR is telling me to lower my stop. So what we do, our traders' application of ATR, which we use in our own charting programs, is that the ATR never goes backwards. It rises. If the value of the ATR drops, we just simply keep on moving horizontally. The stop doesn't adjust.
Yes.
Once the ATR value rises above that level, then we readjust the ATR stop. So our ATR goes dum, 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 dum. Not like up and down like this. It's the difference between the theoretical calculation and the trading application. So when you're looking at some of the work that Bill Williams does with MACD, etc., it's good work, but I find it more difficult to directly apply it in a trading situation.
Yeah, excellent. I hope that answers your question, Robin.